Who here would like to know about stocks that have been oversold and have a 30% upside potential over the next year? I know I certainly would. So I want to cover 5 stocks that either myself or that I pulled from other sources that other people think are oversold and have 30% upside potential. Now, the first 3 stocks I'm going to cover, I'm going to do really quick because these stocks are talked about to exhaustion out there in the financial world. I've done videos on them and I will do future videos on them. So I think there's no need to do a deep dive, but it is important to know which ones I think are great buys right now. And then the last 2 we'll talk about whether I think you should consider it, buy it, or stay far away from it. So let's cover the first 3 real quick. The first one being Amazon. Now, this company is dominant with its cloud business. They are dominant with their AI potential and they're investing in it heavily. They have a great advertising side of their business that earns them great recurring revenue. They have great entertainment options such as Amazon Prime Video that I think a lot of people underestimate. It's one that is very much a competitor to Netflix and brings in a lot of the advertisement revenue and potential for, sports and things like that. Then you have other bets such as Zoox, which is the autonomous driving vehicle business that they want to put out there. And we'll see how that does against Waymo and Tesla. But really, Amazon, they are the company of many businesses. And I think this is one that has been oversold and will potentially go up 30% over the next year. The next one is Microsoft. Now, Microsoft has traded sideways for a while, but I think that this company definitely over the next year has the potential to go up 30%. Now, they also have a very strong cloud business. They're in second place to Amazon Web Services. They are definitely getting into the AI race, and they're going to be integrating those AI components into everything they do, such as their Office products, which is very dominant, right? They have a massive monopoly on that in the corporate world. And then they have things like LinkedIn. They have gaming, which I think will in the future be successful, but they got to just keep on working on that part of their business. Microsoft, they're just a very dominant, well-diverse company and one that I recommend as well. And then lastly is Google. Now, I will say this company I'm considering buying myself. I think it's a buy. I think it's oversold and it has upside potential. There's always a lot of fear with Google. And I'm not going to lie, I've had fear with Google, especially with their search business. And that's one of the areas that they dominate in. And yes, you have ChatGPT and these other learning language models, but I think Google still is its own unique product that there's still going to be separation and much use for Google search. They also have their own cloud, which is in a solid 3rd place. Of course, they're investing in AI. They also have a very strong advertising side of their business. They have YouTube, which I think is stronger than many people think. I talk to so many people out there, and I can't tell you how many times YouTube is mentioned. My dad the other day was talking to me about how he was trying to figure out how to fix something with his vehicle. He YouTubed it, and it worked like a charm. Then they have Waymo, which I think is very promising. Their autonomous driving side of things with robo-taxis, all that. I think Google is one that has brought a lot of fears. It did for me, but I think it just continues to prove that it's going nowhere. So I think this is one to buy with that 30% upside potential because it's been oversold with way too much fear put into that equation. So all these companies, Amazon, Microsoft, and Google, have wide moats. They have strong recurring revenue, which is so important. They have beautiful free cash flows. They offer the convenience factor, which I think is very strong if a company is successful at what they offer of convenience that brings in the customers because they'll rather pay for convenience than something else. And to have that customer dependency, all 3 of these have that. So really, I think these are the dependable, long-term, no-brainer stocks that right now are in the buy range. So yes, we'll see if I add Google. But now let's move into the other 2 stocks that are considered an oversold range according to a few other sources. I thought we would look at these and see if I think they are worth considering or if you should stay far away. Now, investors look for oversold stocks as potential opportunities to buy undervalued assets. However, it's crucial to combine technical analysis with fundamental research to ensure stock has strong recovery potential. Now, factors like the company's financial health, industry trends, and broader market conditions play a significant role in determining whether an oversold stock is a good investment. So the first one that I want to talk about is a company called Generac. Now, this is known for its backup power solutions. Generac has also been flagged as oversold with that 30% upside potential. And if we look at its stock chart, we'll see that over the last 5 years, it's only up 16%. And from its all-time highs, it's down almost 74%. So you can definitely make the argument that it's been oversold, but we got to look more into it. The company has a PE ratio of 25.27 and a market cap of about $8 billion. And what you need to know about this company is it's a leader in backup power solutions, and its growth prospects are tied to increasing demand for energy resilience, which I'm going to talk to you about a personal story here in a minute. But let's keep going. So some recent developments with this company. Generac recently reported strong fourth quarter earnings with net sales growth and record free cash flows. I love to hear things like that. The company unveiled a new air-cooled home standby generator showcasing its innovation in the energy technology arena. Now, some growth drivers for this company. So energy resilience. The increasing demand for backup power solutions due to extreme weather events and grid reliability concerns has been really growing recently. And I know that in my town of Albuquerque, I've had some power outages. One occurred on one of the coldest nights that we had, and I quickly learned that I'm not prepared. I have an electric stove, and I only really had my phone light to go off of. Well, your phone needs to be charged, so eventually, unless the power did go on about an hour and a half later, but if my phone ran out of batteries, I'd be SOL. So I have been thinking of buying kind of like a generator of some sort and some other things like maybe a propane grill just in case I do want to cook if the power's out. But it is something that I think we've seen more of, these power outages every year, especially during the hot summers or the very cold months. So I think that this is an important component to have in every home, and I think more and more people are going to realize that and buy it. Now let's talk about the competitive landscape for this company, because they face some really key players in the power generation and energy solutions market. So there's Cummins, known for its industrial generators and energy solutions. There's Caterpillar, a leader in heavy machinery and power systems. There's Kohler, which offers a range of residential and commercial generators, and Honda Power Equipment, renowned for portable and reliable generators. Now, there are some risks that we got to go over. There's supply chain challenges. Generac relies on a limited number of suppliers for critical components, which can lead to production delays during disruptions. Then there's market volatility. The adoption of renewable energy and battery storage technologies poses a threat to traditional generator markets. Then there's product recalls. This company has had product recalls and lawsuits that have impacted its reputation. That is important, something to consider. Now, some investment strategies. There's a focus on innovation with this company. So Generac's investment in clean energy and energy storage systems positions it well for future growth. There's also market trends. The increasing frequency of power outages and demand for energy resilience are strong growth drivers. And then there's diversification. Investors should consider Generac's ability to diversify its product offerings and expand into new markets. Then I think we need to look at its financials. So net sales, we're looking at the fourth quarter 2024 highlights. They increased by 16% to $1.23 billion compared to $1.06 billion in the same quarter of 2023. Residential product sales grew by 28% to $743 million, reflecting strong demand for home backup power solutions. Net income reached $117 million or $2.15 per share, up from $97 million or $1.57 per share in the previous year. Now, free cash flow, they achieved a record $286 million, showcasing robust cash generation. So overall, I like its recent strong financials, the upside potential it has, and the ability to adapt as a company. I don't like, however, the fierce competition. I prefer companies that are the dominant player in an industry or with a product. So I would say this is a stock to consider and maybe play it as a short-term play with no more than a 2.5% allocation of your portfolio. It's not one I would use as a long-term play. Now, the last stock we're going to cover, it's a company called Medifast. Now, is this company oversold and does it have that 30% upside potential? Let's take a look. So Medifast is a health and wellness company known for its Optavia lifestyle program. And with their recent financials, we're going to look at that first. Its fourth quarter revenue of $119 million was a 37.7% decline from $191 million in the prior year. Now, net income came in at $0.8 million with adjusted net income of $1.1 million. Earnings per share came in at 0.07 cents, and the active coaches, so they have coaches, that decreased by 34.1% to just 27,100 coaches. Now, revenue per coach was 4,391, which was down 5.5% from the previous year. So their financials showed massive declines in almost all areas, not something I like to see. So with their financial position, I also want to mention there were a few highlights. Their profitability. Despite the revenue challenges, Medifast has maintained a strong gross profit margin of 74.1%, showcasing its ability to manage costs effectively. And they have that cash reserve. The company holds $162.3 million in cash and investments with no debt, providing a solid financial foundation, but that can be wiped away if they continue declining in their revenue. So some challenges with this company, they have the declining coach numbers. So the number of active earning Optavia coaches has dropped significantly, which will impact revenue because that's basically their salespeople, which means the lower coach productivity and challenges in acquiring new customers has contributed to the revenue declines. There's also market dynamics. The rise of GLP-1 weight loss medications has disrupted the weight loss industry, requiring Medifast to adapt to its business model. So with their stock price, we'll see that over the last 5 years, they're down 82.27%, but from its all-time highs, they're down almost 96%. You have lost money in this company if you held it over the last 5 years at any point in time. That is not good. Now, their competitive landscape is definitely one that is filled and crowded. They have others like Nutrisystem, which is known for its meal delivery services and structured weight loss plans. They have Weight Watchers, a leader in community-based weight management programs. Herbalife focuses on nutritional supplements and meal replacement products. SlimFast offers a range of shakes, bars, and snacks for weight management. MyFitnessPal, a digital platform for tracking nutrition and fitness. Really, I never really hear about these companies anymore, let alone Medifast. But Medifast tries to differentiate itself through its Optavia program, which integrates independent coaches, community support, and clinically proven products. This personalized approach helps it stand out in the crowded market, but I don't think it's enough. Now, some strategies that this company is trying to do to navigate its challenges are adapting to the GLP-1 medications. Medifast has introduced the GLP-1 nutrition support plan and the Optavia Ascend program line to align with the growing use of GLP-1 medications in weight management. So I do like how they are integrating this more popular area in this economy where people are going toward these GLP-1 weight loss medications and putting it into their plans. I think that's smart. They're also trying to do some cost-saving initiatives. Through its Fuel for the Future program, Medifast achieved $21 million in cost savings in 2024, allowing it to invest in growth initiatives. They also have product innovation. The company continues to expand its product offerings, focusing on high-protein, fiber-rich mini meals and other innovative solutions. They're enhancing customer experience. Medifast is investing in digital solutions and tools and marketing campaigns to improve customer acquisition and retention. I think that is essential these days. And then operational flexibility. By optimizing its manufacturing and distribution processes, Medifast aims to maintain resilience in a challenging market. And lastly, business transformation. The company is entering in the medically supported weight loss market through a collaboration with LifeMD, aiming to tap into a market projected to reach $100 billion by 2030. So the investment potential here, though analysts are mixed with Medifast, they do highlight its innovative strategies and strong cash position as reasons for optimism, and the company's focus on adapting to market trends and expanding its product offerings positions it for potential recovery and growth. Now, its future outlook, they are enhancing coach productivity through improved customer acquisition strategies and expanding its reach in the health and wellness market, including adapting to the growing acceptance of GLP-1 medications. So overall, I do not like this as an investment. I think it will continue to trend downwards. They are trying to leverage some popularity with the weight loss drugs, but overall, I've always seen these types of companies as difficult to grow, and there are way too many options out there for other competitors like we saw. So there's local gyms. There's also people on YouTube that you can follow for free for weight loss advice. So I would not recommend this company, as I think it will result in a 30% loss instead of that 30% upside potential gain. So steer clear of this one, and that's my opinion, of course. Now, here's my portfolio quickly. I'm up 32.35%. You'll see two of the companies I talked about, Microsoft and Amazon. I've added Microsoft recently, and I will be adding some Amazon, and then maybe you'll see Google as a potential new stock. I am just still analyzing and thinking about this, but I don't want to think about it too long and miss an opportunity. So let me know if you have any stocks you think are oversold with great upside potential besides the Magnificent Seven. We want to hear more stocks than just those, so please do share. So with that said, I hope you guys have a successful investing week, and we'll see you soon on Mark Arnold's Finance.